Hello, I'm David Frazier, aka the Market Monk, and this is our daily Market Monk show, where we strive to tell you everything that you need to know and nothing more regarding factors and developments that are likely to affect your investment portfolio. Well, we had another positive day today in the U.S. stock market, with both the S&P 500 index and the Dow Jones Transportation Average making yet another all-time high today on Thursday, May 29th. Meanwhile, the technology-laden NASDAQ Composite Index and the small cap Russell 2000 Index continue to rebound today. However, looking forward, the recent trading action in the U.S. stock market indicates that stock prices in general are due for a temporary pullback within the next few days. For example, the volume of trading that has accompanied the advances in the major stock market indices has been rather light over the past few days, and has been lighter than what it was during the prior week, meaning that fewer and fewer stock market participants have been participating in this rally, have been willing to bid up stock prices further. Secondly, price momentum statistics for the major stock market indices, the U.S. stock market indices I'm speaking of, have now risen to substantial overbought territory. And thirdly, the Chicago Board Options Exchange Volatility Index, commonly known as the VIX, has fallen to a very low level, revealing that stock market participants have become very, very complacent. And generally, when you get such a degree of complacency, if you get any type of negative news, geopolitical or economic, even though I'm not expecting any such negative news over the next few days, but you never know what could happen, that stock market participants will sell stocks in droves. They'll all of a sudden become very concerned once again. But more importantly, looking at the volume of trading and the price momentum statistics, those short-term stock market indicators suggest that stocks in general are due for a temporary pullback within and over the next few days. Now, let's turn to the latest economic announcements. The National Association of Realtors reported this morning that contracts that have been signed to purchase a previously owned home rose for the second consecutive month in April. So that's a very positive development. I mean, the direction of the U.S. housing market is very correlated. Historically, it has been, at least the past 50 years, with the direction of stock prices. And there's a lot of reasons for that maybe I'll discuss on one of our future shows. That was the only major economic announcement for the United States today. In Europe, we also had a positive announcement for U.S. stocks, which I'll need to explain because at first it's going to seem like it's a negative development, but it's not. And that is a major economic research firm reported actually earlier this week. I didn't bring it up over the past few days. I'm just not bringing it up. Reported, I think it was this past Monday, that the overall business climate in Europe deteriorated over the past 4 weeks. And my thinking is, looking at a lot of other statistics out of Europe, even though the Eurozone economy has definitely stabilized, and I expect economic conditions to continue to improve over the next couple of years in Europe. But in the shorter term, there have been some statistics that suggest that growth might slow over the next few months. And now, the reason I say that's a positive development for the United States, well, my opinion is that, well, you may not know this. First, let me mention this. So let's set that aside for a moment. So that we're seeing some indication of a slowdown in Europe over the next few months. Number one. Number two, I'm quite certain that the European Central Bank's president, Draghi, I know he's looking at these statistics, and a lot of people, including myself, expect the ECB, when they make their decision next week on interest rate policy, to at least maintain short-term interest rates at the current levels and to possibly reduce interest rates there. So now let's get into why that's a positive development for the United States. It's a positive development for the United States because some of you may know that lending rates here in the United States in general, whether it's very short-term rates or mortgage rates, really lending rates in general, have been trending lower since the beginning of this year. And that comes as no surprise whatsoever to me. I mean, in December of last year, I remember having some short conversations with some so-called financial advisors, people who are paid to bring in money to brokerage firms. That's really what they get paid to do, and they keep their jobs and they make a good amount of money if they bring in money. They're not judged on the value of their financial advice. I got into some conversations with a few of those people in December of last year, and they were shocked by, they were really concerned about, they were shocked by some recent movements higher in U.S. lending rates, and they were very concerned that rates were going to rise sharply. And I just said to them, well, it sounds like to me, if you're concerned about that, maybe you just have your client's position wrongly. You should have thought about this before. But that's another issue. The reason I bring it up is a lot of people, I'd say the majority of so-called experts, were thinking late last year that lending rates here in the United States were going to move higher, considerably higher, during since that time. And they haven't. They've gone just the opposite direction. It comes as no surprise to me whatsoever. I've discussed this on occasion and updates, reports to persons that subscribe to our financial market newsletters. So I'm not going to get into it here. This show's not to be meant to be an in-depth, extremely analytical, detailed show. It's meant just to report on major factors and developments that occur on any particular day of the week, and we're talking about today. But so if it seems I've gotten off track here, okay, one, there's signs of an economic slowdown in Europe. Two, a lot of people, including myself, expect the European Central Bank to keep interest rates where they are and possibly lower them next week. Number two. Number three, interest rates have not only been trending lower here in the United States over the past 5 months, but have fallen pretty sharply over the past couple weeks. And my thinking is that's what's happening is big international banks, major global investors, institutional investors, are also expecting the European Central Bank to keep rates where they are or possibly lower them. And therefore, even though rates are low here too, on a relative basis, they're higher than what they are in Europe. And so foreign investors are, in my opinion, are behind this recent drop over the past couple of weeks in interest rates here. And there's a lot of data to support that. For example, I'm not going to get into all that here. There's lots of data to support that. Remember, this show is not about our beliefs or our unfounded opinions. It's only about the facts. And anything that I say, I have the data and the facts to support it. I may not always get into it here. And part of the reason is because subscribers to our newsletter services pay for that type of information. Okay. So, why is that a positive development? This is very, very long-winded here, I know, but I need to explain all this. Well, if money's flowing in from abroad into the U.S., into our U.S. Treasury markets, pushing lending rates here lower, including mortgage rates, which is very, very important, well, that's very, very positive for the U.S. economy for interest rates to remain at low levels. So that's why that's a positive development. Let's see. There's one other thing I think. I want to look at my notes here real quick. Unlike most people who do these types of videos and TV shows, I do not use a teleprompter. I review the facts every day, and I just come online and I I don't use a teleprompter, so sometimes I need to look at my notes. Let's see. Yeah, the one other thing that I wanted to bring up is gold prices. Gold, futures contracts on gold on March 17th of this year resumed a longer term downtrend that began during October of last year. And my research indicates that spot gold prices are very likely going to break below the 1200 level by the end of July, and a very good chance that gold bullion is going to fall below $1,000 per troy ounce by the end of this year. And this downtrend also is no surprise to me. You had so many people, if we go back 2 or 3 years ago, supposedly gold was going to $2,000, $2,500, and possibly $5,000 an ounce. There was going to be rampant inflation in the United States, hyperinflation. All these things, and actually most people have said that. They never actually outright forecast it. They don't ever want to do that, those type of people. They only tell you what could happen. Well, I don't care about what could happen. Lots of things could happen. A plane could crash into this building right now, and I might be dead in the next few seconds. I hope that doesn't happen. Rather than talking about what could happen and to prey upon financial markets participants' emotions and fear and greed, I look at the data. I do a lot of research. And there was an abundance of data and information to suggest that there's no way there were going to be any inflationary problems here in the United States. This is going back a couple of years in the foreseeable future. And that continues to be true. And the reason I bring that up is gold prices are determined almost entirely by only two factors. One is short-term geopolitical developments that are of a big concern, such as one country attacking another country, a war developing. And the other reason, those usually tend to be very short-lived. But the primary reason that gold tends to move higher is it tends to do so when people think there's going to be a lot of inflation coming, or when there actually is a lot of inflation. And we're just not in that type of environment. So more and more people have woken up to what I would consider to be the fact that we're not going to have any inflationary problems. We're continuing not to have inflationary problems, at least for the next couple of years, any problematic inflationary problems. So, gold bullion does not pay dividends. Gold ETFs do not pay dividends. So if there's no price appreciation, there's no, gold bullion continues to move lower, there's no reason to hold securities that invest in gold bullion. And therefore, as more and more people wake up to this realization that there's not going to be an inflationary problem, I expect a lot of those people to sell their gold holdings and to roll it into the stock market. So, anyway, a little longer than I expected today, our show, but remember, as I try to tell people very often that watch and listen to this show, we don't have a specific amount of time that's allotted to this show. I do like to keep it under 20 minutes, but some days the show might be only 3 minutes, and sometimes it might be 20 minutes, but it's not going to be some specific time scale just to talk about something or to sell advertising spots. We tell you everything that you need to know based upon my very detailed research of economic and geopolitical factors and developments around the world, as well as just trading action in the securities markets. But to tell you nothing more than that, only to tell you what you need to know. So that's it for today. I thank you for watching and listening, and I'll speak with you again tomorrow.